If you're someone who struggles with figuring out where's price most likely to go, or you have trouble figuring out bias and you're always stuck and thinking, oh my god, how do I figure out bias? What do I need to do in order to figure out bias? Imagine trading and in certain moments in price, you know exactly what price is going to do with high probability of certainty and accuracy, and you know it so well that it feels illegal because of just how good it works. Well, that is exactly what low resistance liquidity runs allow you to do. And in this video, I'm going to be showing you exactly what low resistance liquidity runs look like, when they form, how they form, and what to anticipate from them. And I'm so confident in this concept that I did something that I've never done before. I did a live analysis during the video, forecasting what price is going to do, using exactly the same ideas that I'm going to be sharing with you in this video, that after you watch this video, you're going to be able to go and look at that live analysis and see if I was right or not. So be sure to stick around and watch this video all the way through to the end, because you're not going to want to miss out on this. And by the way, if you haven't already, after watching this video, be sure to check out my free Telegram, links in the description below. I'm posting free analysis, free weekly analysis, trade breakdowns, and trade ideas, and it's going crazy. The people who are in there right now can tell you that in the comments below. Anyways, let's get into the video. Alright, cool. So what is a low resistance liquidity run? Now, this is by far one of my favorite ways of forming bias, and a lot of people always struggling saying, how do I find bias? How do I find daily bias? How do I find this? If you just pay attention to this video, this is going to be one of them videos that it's just gonna make so much sense to you, and you're gonna have another edge in terms of how to find bias. And if you can find bias, you can frame your trades around. What is a low resistance liquidity run? A low resistance liquidity run is literally a run on liquidity that has little to no opposing resistance, hence it's dubbed a low resistance, since liquidity rests below lows and above highs in the market. The easiest way to think about it is in support and resistance terms. And by support and resistance terms, I don't mean the classic support and resistance that's taught. I mean in terms of ICT concepts, the true support and resistance. For example, if we're bearish in the ICT world, we expect bearish PDRAs in the form of bearish fair value gaps, bearish order block, to be a resistance for price. And if we're for bullish, we expect bullish order blocks, bullish fair value gaps, all the bullish PDRAs to support price. And essentially, if these PDRAs fail to resist price in a bearish example, this is where low resistance liquidity runs happen. Now, why are low resistance liquidity runs important and why they're useful to us? Well, low resistance liquidity runs give us the easiest draw on liquidity, and if we can frame a draw on liquidity, we have our bias. This then creates a high probability condition of what is price most likely to do next. And that's one of the most important things when you're trading, is that what is price most likely to do next? And if you can figure that out, you can frame your trades around that condition. And just by virtue of us framing our low resistance liquidity runs on a daily chart, because we're predicting just the next few candles, those few candles on a daily chart, those are literally full days of trading. So if we can just predict the next candle on a daily chart, we've literally predicted what the next day of trading is going to be. And you see how powerful that is? Just by switching and operating on the higher time frame in terms of looking for these low resistance liquidity runs, we can literally find days worth of bias just by doing it this way, which would then literally be by default a high probability daily bias. And then that then gives us our framework to base our intraday trading around. And why do I say low resistance liquidity runs are high probability conditions? Well, if you think about it, right? Price only has two functions, and price is only ever doing two things. It's either seeking liquidity or inefficiencies. Now, the idea of low resistance liquidity runs is that if price is near an old high and there's little to no resistance, there is a high probability that price is going to reach for that high, just by virtue of price having a base function of either seeking liquidity or seeking inefficiencies. If price is near an old high on a daily chart, that is a high probability condition based on the core function of price that price will draw towards that high. And this is because there is no resistance, so it's easy for price to meet one of the only two functions it has. So we anticipate price to reach that high. And by us anticipating price is going to reach for that high from where it currently is to that high, the distance between the high and where price is currently trading at, that is where we then frame our bias, because we can then anticipate that price is close to this high, so this distance here we should expect bullishness, so we can anticipate the next few days or the next day of trading to be bullishly as price draws higher towards that high. All right, now how do you spot low resistance liquidity runs? And this is the easiest way. So if you look at the daily trend, you see that price is near an old high. That's a signal for you to start looking for confirmation of that low resistance liquidity run. And what does that confirmation look like in price? And when can we anticipate this to happen? This is where my logic of the last defender comes in. And what do I mean by this? Well, if you think about it, right? When a swing high or swing low forms, there's usually a bearish order block or bullish order block that's coupled with that swing low, or bearish order block that's coupled with that swing high. And essentially, if you think about it, the logic behind a low resistance liquidity run is that the only thing that's stopping price from reaching this high here is this bearish order block. So once this bearish order block is invalidated, there is nothing really stopping price from getting to this high now. And how do you know that there is no more resistance? Well, we base this around this bearish order block here being invalidated. And how does this bearish order block be invalidated? So there's two main resistance levels to a bearish order block. The first level of defense, because you got to think about the logic. If we're anticipating price to be bearish, right, we should see price react to these levels. So the first level of defense is the opening price of this last up candle before the move down, which is the bearish order block. So that's the first level of defense. The last level of defense for this bullish order block here is its mean threshold, which is the 50% range of the body of this candle. And once this is invalidated, by invalidated I mean once price violates this 50%, and it only violates the 50% by having a daily close above that 50% level, once that happens, this is no longer looked at as a bearish order block because price has invalidated it. So that means that there's a high likely chance that price is not going to respect the resistance of this order block. And once we see that happen, that's our indicator that now we can look for this high because it's now deemed low resistance. And then what do we anticipate? Then we anticipate just price have a smooth run and give little to no back and forth as it draws towards the side. This then becomes an easier draw for us essentially. So once this happens, the distance between where price is currently trading at and the high, that range there is the range we're going to work with in terms of framing a bullish perspective. So we're going to anticipate price to move bullishly between this range as it draws towards this high. That range here, what that we're working with, these small pockets in price, they become then high probability, because then this range here for price, in order to close this range between the high and where it's currently trading at, it could be 1, 2, or 3 days. So what does that mean to you as a trader? That means you have 3 days where you potentially anticipate buying. And those 3 days, you're going to have your bullish bias. And then from that bullish bias, you're going to have a daily bullish bias, because then you're going to be anticipating price to react bullishly during the day. And so intraday, when you're trading now, you know what price is ultimately drawn towards, and you're just going to be trading in line within that direction. And it's just these small pockets of range that you then find your consistency in. And then you can anticipate what price is most likely to do next. All right, now let's look at a bearish perspective. And again, in the bearish perspective, we have the last down candle before the move higher. We have the opening price of that order block. That is like the last defender, because at swing lows, we'll always have that order block. That's like the last protector of this low, if that makes sense. So once that goes, there's nothing really protecting this low anymore. So our signal to us is when price is near here and it invalidates this 50% level by having a daily close below that 50% level, that invalidation is a signal to us that, okay, a low resistance liquidity run is in play. So the framework is, we see prices near an old daily low. The confirmation, we see price invalidate the order block protecting the low. That confirmation comes by having a daily close below the 50% level. Obviously, if we're anticipating bearishness, vice versa if we're bullishness. And that's when we start anticipating price to just naturally draw and run towards that. And that run is where we then frame our bias within, because we know price is going to be bearish as it reaches for that low. And that is it. And that's the logic, because if price was bullish, when it came down to retest this daily order block, it should have respected it. But by virtue of it disrespecting us, that's sending information to us. And that's the logic behind low resistance liquidity runs. Now let's go do some live analysis so you guys can actually see me use this information in real time. So when you then do see this video when it comes out, you can see whether I'm full of shit or not in terms of actually using this information and framing a bias around. So I'm filming this video on literally the 25th of November 2025. This is the daily chart for Nasdaq. So based on the information I just gave you on low resistance liquidity run, what did price do? Price violated this bearish order block that should have been respected if price was going lower here as it traded below these lows, right? Price violated it here on this candle. So what is stopping price from reaching into these highs right here? Nothing really, if you think about it. And if this is one of the functions that price likes to operate under, these highs here become an easy draw for price. So what does that then mean for me? So that means that I'm anticipating a run on this high and this high because there's nothing really in the way for price getting here. So that means that I'm anticipating where currently price is trading at to where this high is. This range here is what I'm going to work with to frame my bullish bias, because there's a high probability that price is going to reach into the high. So the next few days or the next 3 days, price should reach into the highs because there is no resistance. If it was supposed to be bearish, it should have respected this bearish order block, but because it didn't, now these highs become a draw on liquidity. So tomorrow on the 26th or the 27th, I'm going to be bullish. I'm going to anticipate price to behave bullishly. So then that means that when I'm operating, when I'm day trading, I'm going to anticipate bullish things in price. So that means at 9:30 open, I'm anticipating price to go lower before it goes high. You see how you start to then frame how price should behave within this narrative that this is the draw on liquidity. So yeah, by the time you're watching this video, go check this out. Go see if I'm telling the truth or not. And if this does pan out, this one's for the haters that are going to try to say, oh yeah, he was using the bar replay. No, look at the dates. Literally, I'm filming this on the 25th of November. Tomorrow is what's been anticipated for the news. How do I change this so you can see? So you see, today was the 25th. There's nothing beyond this, so this is the 25th, and as you can see, the date here as I pull the calendar up is right here. No bullshit, no nothing. So yeah, just wait and see if price does draw to this high based on this logic here, and you're gonna see that it works. And that's all you literally need in order to frame high probability trades. Like, you can just wait for these moments where price is so one-sided and it's so obvious what it's gonna do based on the logic I just given you, and you're going to see that your consistency in the way you execute on price and your accuracy of knowing where price wants to go is gonna go up, because you're not trying to predict what price is going to go for the next 10 weeks, 10 years. You're just predicting what's price most likely to do next, and that's what's important when day trading. We want to know what is price most likely to do next, and this logic I've given you here on low resistance liquidity run is the logic that helps you when it's there to know what price is most likely to do next. And if we can know what price is most likely to do next, we can anticipate and act on that, and that's what gives us our bias and our daily bias. So yeah, let's go look at some other few examples. And obviously, as price reaches into this high, I'm going to be looking at this bearish order block here. So once price does then violate this bearish order block, I'm then going to be looking at these highs and so on and so on. I'm just wait for price to give me information, then I act. All right, this is the GBPUSD, another live example. Remember, we wait for the 50% to be violated. So let's see if the 50% level has been violated here. So price did have a daily close above the 50% level of this bearish order block. So I'll literally be looking for GBPUSD to run this high here and this high here and reach into this inefficiency. So this should be a low resistance liquidity run. Another perfect example is right here. The signal for us to start looking for low resistance liquidity run is when order blocks are violated. The order block here, violated. So there is no more defense for this low. And look what happens. Price trades below the low. Simple stuff. It literally happens here again. This bullish order block here, last down candle for the move up, is violated here. The 50% level of it is violated here. The daily close happens here. So there's no more defense for this low. Price is trading near this low. Low resistance liquidity runs. So we have a bearish perspective on price. What does price do? Price comes in and takes the low. Very simple stuff. We can keep going. We can keep looking for more examples and more ideas, right? This key low here that we have in price here, this order block is the only defense left. What happens? It's violated here, right? By this down close candle that closes below 50%. And what happens? Look, price runs the low. So you can see there are many examples where this happens, and this is the art of low resistance liquidity runs. And if you guys just master and go and back test and go start looking at price this way, when it does form, you're gonna see you're gonna have some of the easiest ways of just knowing what is price most likely to do next. And that's all that matters, is what's price most likely to do next. And when this does happen, and when this is present in price, you now know what to look for it to be deemed a low resistance liquidity run. You now know where it should happen. It happens when price is trading near old lows and old highs. When it should happen, when the order block or the last defender per se is disrespected. I hope you guys found value in this video. If you did, leave a like. Let me know in the comments below if I did teach you something new in terms of finding biases. One of my favorite ways of just knowing what price is most likely to do next. This video is part of the series that I'm making this December, where I post a video every day up until Christmas, 25 days of Christmas, shout out ICT, where every day I teach something that I've learned from 9 years of trading ICT content with the hope of improving your guys' trading and allowing you to get to your success faster. Like, comment, subscribe, and I'll see you tomorrow for the next episode.